state-based tax and away from the state-based royalty system. Where the disagreement is 6% really a super profit, and is the 40% rate a fair representative of how much that should be taxed? So again, this is my understanding. I hope it's accurate because I'm talking to you about it, but the government is saying that you can get up to a 6% return on investment of your money. Beyond 6%, that's a super profit. Now, to me, a 6% return is not a super profit. And for the cost and the risk associated with digging a great big hole in a desert and looking for iron ore, a 6% return and still paying 30% tax on that 6% return if it's a company is not necessarily a great motivator. To then say we're going to tax you 30% up to 60%, plus we're going to tax you an extra 40% on top of the 30% beyond 6%, to me is an unfair shake of the sauce bottle, Mr. Rudd. And while it's good to have tax reform, it's good to innovate, it really, unfortunately, is not good to be overtaxing an area of our economy that is causing jobs and leading indeed the country. There will be a time in the future where the miners are not doing so well, and then this will be really a disincentive for new investment in Australia. Personally, I believe life will go on. There'll be a negotiation, the government will come to terms with the miners, everyone will eventually hug and shake hands, there'll be kisses on the cheek, there'll be some babies brought in for good measure, and everyone will shake hands and say, all right, it's not quite what we want, but we're willing to live with it, and life will go on in Australia. But what may not recover is the political stability in Australia. The idea that the government can wake up one day and just slap on a big new tax, which is what it is, on an existing industry that takes years and years to get developed, decreases the political stability of the Australian business landscape. And that is not something that's going to be easily fixed, and I think the impact on that won't be felt for a little time into the future. As far as the housing market, the resources super profit tax probably isn't good for it. It creates that uncertainty I spoke about earlier. And certainly in mining towns, if projects are shut down, then the housing in those areas will suffer pretty quickly. The rents will go down and investors may be left feeling a little bit sick and sorry for themselves. Indeed, the uncertainty relating to the resources super profit tax is probably enough in and of itself not to be an aggressive buyer of properties in mining areas. And certainly I wouldn't be renegotiating rents necessarily right now if the party you're negotiating with wants a significant discount on the back of the uncertainty of the resources profit tax, super profit tax. Again, I think it'll be resolved, and once it's resolved, you'll be able to renegotiate a higher rate with more certainty. If you've stuck with me, you've done well. We're almost at the end. The next thing to talk about is housing finance, and the numbers for housing finance weren't particularly strong for the April month. Owner-occupied housing, the number of people doing owner-occupied fell by 1.8% on the month, down by 25% year on year. This time last year, though, the federal government was putting out lots of stimulus in the form of the boost and saying it was going to get wound back, handing people money. So it's reasonable to expect that last year was a bumpy year and that this year will be down a bit on that. That said, investing, if you like, of course, in housing, is up on last year and indeed is up on month. So it looks like the investors are willing to buy, but the homeowners are not. This speaks to the lack of demand amongst the first home buyer market, but a reasonably buoyant investor market on the back of the growth. Looking forward, as price growth flattens out, you would expect that the investor finance numbers would be down a little bit. And if we have down investor finance numbers and we have down homeowners, then we can imagine that there is still demand in the housing market, but it's not this rampant demand that was enough to keep property prices booming into last year. Again, it speaks to a flat property market into the rest of 2010. Let's move on now and talk about the US economy. And the best description I can give for the US economy at the moment is that it's life, Captain, but not life as we know it. Of course, that's a quote from the great Dr. Spock, and I found a very amusing photo of Obama dressed up as Dr. Spock. Thank you for the wonders of Photoshop. The forecast for the US economy, if you're wondering, are for moderate growth. We're looking at unemployment of 9.5%, and in case you're wondering, that's 4.5 million people, which interestingly is all of Melbourne and all of Tasmania put together. So if you imagine all of Melbourne was unemployed and all of Tasmania, that's how many unemployed people there are in the United States at the moment, and clearly that's a lot. That said, they're expecting GDP growth of between 3.5 to 4%. Clearly not the train wreck that was 2008, 2009, indeed some sort of recovery. Looking ahead then, what can we say? Well, looking at the screen, here are the points. First of all, the policy shift in New South Wales does not solve the planning delay. If it's going to take 18 months for local councils to approve new planning applications, then people can't live in houses that aren't yet in existence. So it's a good policy, but it's not a policy that's going to solve the problem overnight. Secondly, there's enough power in the economy for low housing growth to continue. Yes, we're talking about decreasing housing finance numbers and we're talking about a flatter property market, but that doesn't speak to a property crash. It just means that we'll probably have flattish prices, but indeed the overall trend of low growth should hold for 2010. The more demand than supply on our rising population, if people aren't buying new homes, it means they're renting. And as I've said to people, I believe that the growth story for the second half of 2010 won't be house prices, it will be increases in rents. As there are more people looking to buy property, still lower vacancies because we're not building enough new houses, and the only thing that can shift there is demand in rentals. So expect rents to increase in the second half of 2010. Our application as investors then is that interest rates are likely to keep rising. You need to factor that into your cash flow, and you need to also factor that into your quick cash modelling, which means, dare I say it, that you need to be very careful when you look to improve outside of general market forces, but that is the best opportunity for growth buyers. As far as interest rates, if you can get a good deal, you might want to look to lock them in. So once again, look, if you're a growth buyer, don't be relying on the general market to increase your returns in the second half of 2010. You're going to have to look to evaluating opportunities to do it yourself. In terms of interest rates, they're more likely to go up than they are to go down, and in that regard, you need to factor that into your modelling, and you also need to factor that into whether or not you want to lock them in if you can get a really good deal. For value-add investors then, there are still plenty of good deals out there. Be conservative with your end sale prices though, in terms of how much growth you're expecting, and also be conservative with your estimation on exactly how many days it will take to sell. It might take up to about another 30 to 45 days to sell your property, which means you've got extra interest costs that are going to decrease your margin on that property. The conclusion then, and I've quoted here from Isaac Asimov, is the only constant is change, continuing change, inevitable change. That is the dominant factor in society today. No sensible decision can be made any longer without taking into account not only the world as it is, but the world as it will be. Friends, change is here. It is here to stay. There is always a redistribution of wealth when change occurs, and as investors, we need to have the smarts to be able to identify where the change is happening and how it impacts on the property market. I hope that this video has helped you to identify those areas that are changing at the moment and given you some new ideas and insights into how to position yourself to make the most of them. The final thing to say in this update is that next week we're going to be doing a very interesting scratch, dent and surplus stock sale at PropertyInvesting.com, where there are going to be some really great deals on some A-grade, high-class, high-quality education materials. Watch out for my email about that next week. Well, until next time, I hope you enjoyed this update. All the best. Bye-bye for now.